Alright, welcome to another video in the earnings season series. And in this video, we are previewing the earnings we're about to receive this week. And right away, today we have earnings from Johnson & Johnson, Lockheed Martin, General Electric, 3M, American Express, Starbucks, and Microsoft. And on Wednesday, we're looking forward to hear from Boeing, AT&T, Whirlpool, AMD, Tesla, Facebook, Apple, and Las Vegas Sands. On Thursday, we will hear from McDonald's, Northrop Grumman, Visa, Mastercard, Southwest Airlines, Skyworks Solutions, and Mondelez. And lastly, on Friday, we will hear from Caterpillar, Eli Lilly, Chevron, and Honeywell. And let's start by previewing the earnings from Johnson & Johnson. Right away, when we look at their last earnings report in the consumer health segment, which experienced growth of 11.6% in the United States. However, the growth came short in the international market segment, down 5.6%. So we are looking for an improvement in the number for the international growth in the consumer health segment. The outperformance is from the oral care segment, and this growth is very unique to the pandemic situation since the majority of dentists are closed across the globe, but specifically here in the United States, consumers are paying more attention to oral care and they are buying Listerine in specific from Johnson & Johnson, the mouthwash, to maintain their oral hygiene. So we are looking for this number, whether we will see a continuation in the growth or a retreat, and if that is the case, are we going to pick up growth in the other lagging segments? As we transition from staying at home to reopening, are we going to see a rebound in, say, the women's health segment, which was down 9.6% year over year during last quarter? As far as the pharmaceutical segment, there are no worries there. This segment is doing very well during the last quarter, and I expect it to continue to do so. But we are expecting to hear about the COVID-19 vaccine trial results from Johnson & Johnson, and that would be perhaps the most important thing to look for in this particular report. What about the medical devices segment? Once again, experiencing 1.2% growth year over year during the third quarter. However, in international markets, this segment was down 8.1%. So the weakness for Johnson & Johnson is in international markets, specifically over in Europe. We are looking for an improvement in the international markets numbers for Johnson & Johnson. Next, we have Lockheed Martin. And this is the outlook they gave us for the full year of 2020. And the question is, will last quarter's earnings fulfill the outlook from the third quarter? And of course, all eyes are on the space segment. This is the most exciting segment in Lockheed Martin, and it is the key for growth in the future for this company. We know the excitement about all of these space names. Kathy Woods is creating a new ETF for space exploration, and Lockheed Martin will be added to that ETF. So we're anticipating, we are looking at the numbers and the outlook for the space segment in Lockheed Martin. And once again, this name has been underappreciated due to the anticipation from the market that the Democrats' control over the government is bad for defense contractors such as Lockheed Martin. I disagree with that. I think Lockheed Martin will do just fine under a Democrats' administration. And the key here, of course, if we see a decline in sales, say in aeronautics or the rotary mission segment, are we going to see that being substituted with growth in the space or missiles segment? And let's take a look at the chart and see where Lockheed Martin is trading right now. As I said, the name has been underappreciated, and we are battling a very critical level of support here at around 339. The earnings will be very critical to determine whether we're going to break the support or mark a bottom and trade higher from this point on. I'm leaning toward positive earnings for Lockheed Martin, and that we will see the name marking a bottom here and trading higher from this point on, catching the support from the level of 339. Next, we have General Electric, and this stock has been on a tear since the bottom. It is becoming increasingly popular with retail traders. However, when we look at the earnings report from last quarter, we know that the aviation business is the weakest spot for General Electric. The revenue was down 39% year over year last quarter. We are looking for the slightest improvement here, even if it is marginal. Any improvement will signal that the bleeding has stopped and the worst is behind for the aviation segment in General Electric. Likewise, while the healthcare segment for many other companies is thriving under the pandemic situation, we see the opposite picture here for General Electric. The revenue growth year over year was down 7% last quarter. So we're looking for an improvement here. We know that hospitals are very busy with the current COVID-19 situation, but as the new stimulus arrives, and we saw the rate of hospitalization of COVID-19 patients trending lower recently, are we going to see hospitals using the stimulus money to replenish their equipment and devices? And would that be good for the business of General Electric? And of course, one of the hottest trends as of late is the renewable energy trade. This is still underappreciated segment for General Electric. We saw 2% revenue growth year over year. And the question is, will this segment under the new Biden administration become the new engine of growth for General Electric? To know that, we need to see growth, not just year over year, but quarter over quarter during this upcoming report. Next, we have 3M. And once again, this is an underappreciated business. We know from the last report that this company is seeing the light at the end of the tunnel, and it is growing once again. The safety and industrial segment grew about 7% year over year during the third quarter of this year. Likewise, the healthcare segment up over 8% year over year, and the consumer segment up over 5.5% year over year. However, the transportation and electronics segment remains the drag for this name, down over 7% year over year. Now, there's this misconception among market participants that this company should rally due to the demand on masks. Masks are a very tiny portion of 3M's business, and we know that that will thrive under the pandemic situation. But the number to look for here is the transportation and electronics number. Are we going to see an improvement in the fourth quarter? This is the single number that I am looking for. And what about the chart of M? We see a descending trend line acting as resistance all the way back since the top in 2018. We are seeing a reverse head and shoulder formation in the chart, and we have already broken that descending resistance line. We have checked it for support. The chart looks technically very, very healthy. And if the numbers meet expectations and we see improvement in the transportation and electrical segment, this name could rally significantly higher, and we will see market participants appreciating this name a little more. It's a dividend-paying name, and perhaps the worst is behind for M. Next, we have American Express, and this is a stock that I used to own last year. It rallied significantly, and I had to sell it and take it off my portfolio because I think the run is a little premature. Here are the numbers from the third quarter. The total revenue was down 20% year over year. Likewise, net income was down 39% year over year. These are disastrous numbers, and we are looking for an improvement here in the fourth quarter. If the numbers for the fourth quarter come worse than these numbers, there's going to be a lot of pain for this stock, because the expectations are that we were seeing some reopening in the economy. We have just been through the holidays season, which is known to be very good for credit cards spending. And let's take a look at the chart. This is a weekly chart, and you can go all the way back in American Express chart all you want. The chart never leaves a gap open like we have seen since November of last year. So I am assuming that regardless of how good the numbers are, American Express will trade lower, and we will go all the way back to at least test the support line of 105, if not going all the way back to close the gap we left since November of last year. And of course, if that happens, you bet that I will add the name back in my portfolio, because this is a recovery story. Make no mistake, American Express will come back once we reopen and normalize the economy. Next, we have Starbucks, and the number I'm looking for is the China comparable store sales, which was down 17% year over year last year, and the company saw a 21% decrease in comparable transactions in China last year. We're starting fresh, a new year. Are we seeing an improvement in the numbers in China. China is the key for growth in Starbucks, and we're also looking for their strategy of opening more drive-through stores. Now, let's visit the chart of Starbucks. While the company suffered lack of financial growth last year, magically the stock managed to do very well and it made all-time highs. So what do I see here? I see head and shoulder formation. I see weakness. The MACD indicator is about to cross and create red impressions in the histogram. We are seeing a loss of momentum from the RSI from a weekly perspective. I say regardless of how good the earnings report might be, we will trend lower after earnings, going all the way back to revisit the 20 weeks moving average. Next, we have Microsoft. And the market, of course, is looking for two things in this business: the growth of their gaming segment, specifically Xbox, but most importantly, the Azure cloud business. And in the last report, Azure revenue grew 59% year over year. This is a monstrous growth. And the question is, with the rising competition from Amazon, IBM, and in international markets, Alibaba, will Microsoft able to maintain the revenue growth in the Azure business and build on it? So we're looking for a number bigger than 59%. It's a very difficult task to do, so the expectations are very high, but Microsoft proved over and over again that they have the ability to continue to maintain their growth. And let's visit the chart and see what's going on here from a weekly perspective. We are still at the wedge consolidation. This week we have managed to break above it, which is a positive development. But the week is not over yet, and while every technical indicator is leading toward a positive rally in Microsoft shares, if that Azure number comes up a little light, we will see a disappointment and a negative reaction in the stock, perhaps going back inside the wedge once again. So the weekly close for this chart is very important. And moving on to Wednesday, we have Boeing. And of course, we know that the defense business for Boeing is doing fine. The problem is coming from the commercial airlines unit, specifically the orders for the new 737 MAX jet. Now that we have clearance from European regulators and American regulators, are we going to see a recovery in orders for the 737 MAX jet? That is number one. Number two, the revenue for the business was down 38% year over year during last quarter's report, and we need to see an improvement here. Boeing cannot maintain losing 38% year over year. We need to see improvement here. And we know that we have a backlog of about 4,000 planes to be delivered from Boeing, but that is all accounted for in terms of accounts receivables. So once again, we are looking for a recovery in the 737 MAX orders. And let's take a look at the chart from a weekly perspective. We are looking at a bull flag formation, and the natural conclusion here from a technical perspective is the chart will break to the upside and the resistance level is the 253 level. Now, there are no guarantees here that the chart will react as the technicals are suggesting, because the numbers will speak the loudest at the end of the day. Next, we have AT&T, and we will skip reviewing AT&T's last quarter's earnings because we know what the market is looking for: the new HBO Max subscription numbers. This is the new engine of growth for AT&T, and this is what the market is looking for. We need to see growth comparable to the bar set by Netflix and Disney Plus. Next, we have Whirlpool. And while this business suffered under the Trump's administration, the pandemic was very good for the recovery in Whirlpool, and perhaps removing the tariffs under the new Biden administration will be very good for the business. But the stock is already trading almost at all-time highs. We saw from the report of last quarter that the bar has been set very high. The net sales grew about 4% year over year, and net earnings grew 11% year over year. Very impressive numbers for Whirlpool. But remember, the pandemic was a tailwind for the improvement in sales numbers for this company. The question is, how sustainable are the gains? Were they just a trend during the summer of last year, or are we seeing a continuation of the same trend all the way throughout the winter? I'm leaning toward a softer earnings report this time around, because these numbers from Q3 set the bar really high. We will see a trend lower in my opinion. Next we have AMD, and here are the numbers from the last report. The revenue was up 56% year over year. Meanwhile, the net income was up 225% year over year. This company is experiencing monstrous growth. They're absolutely crushing Intel and everybody else. The problem is that these numbers once again set the bar really high. The expectations for growth is that during the fourth quarter, we will see these numbers ticking even higher due to the shortage in chips, which was a tailwind for prices. Any disappointment, even if the numbers are impressive, say the revenues for the fourth quarter are up 48% year over year, that would be a disappointment because it will signal a slowing trend in growth quarter over quarter. You gotta pay attention here because the numbers alone are very impressive, but you have to pin them not just year over year, but quarter over quarter. Your job is to figure out where the trend is heading, not where it was. Next, we have the big kahuna, Tesla. What are we looking for here? It is very simple, the profits number. Once again, from the last report, we know that Tesla is growing rapidly. The revenue numbers grew 42% year over year, and they have no problem whatsoever in terms of cash flow. This was the concern, and it was the bear thesis when they started shorting the name 2 years ago, that the company will not have any cash. Well, look how things turned out to be. Tesla is flush with cash thanks to the movement in the stock price. They were able to raise a lot of cash, and of course, the Model 3 was a success, generating plenty of cash for the company. So we are not worried at all about the cash positioning for Tesla. We are worried about the profitability, because last time around, take a look at the revenue number, specifically where it says of which regulatory credits. That number came at 397 million. And then let's take a look at the net income, the GAAP net income that is. It came out at 331 million, meaning that without the regulatory credits, Tesla would have not been profitable last quarter. And if we're seeing more and more companies developing their own EVs, they no longer need to use Tesla's regulatory credits, and the competition is driving Tesla's margins down. The problem here and the source for concern is, what if Tesla delivers a report where it's not profitable? That would be a massive disappointment for the stock. An upside surprise, however, will be the fact that if we see the company delivering a positive profit number regardless of the regulatory credit, meaning that they're finally making profits from their core business, selling cars. So a profit number is what we are looking for here. Next, we have Facebook. And what are we looking for here? This is the report from last quarter. And as you can see, revenue grew 22% year over year, while the net income grew 29% year over year. However, I'm not concentrating on those two numbers, and I could care less about the user's growth. That means nothing at all. I am looking for the margins for this business. Specifically, take a look at the total cost and expenses, because during the third quarter, expenses grew 28% year over year, just slightly below the growth of the net income, which came at 29% year over year. If Facebook is going to continue to spend like a drunken sailor, hiring people to police the platform, that would add a lot of pressure on their margins. We don't want to see in this report that costs and expenses grew larger than the net income year over year. That would be a turning point from which we will realize that Facebook is no longer a hyper-growth company due to the rise of their expenses. Next, we have Apple, the biggest kahuna of them all. And here is the report from last year. And here is the problem. Take a look at total net sales. Year over year, barely grown. And also take a look at net income, which came at negative growth year over year. Meanwhile, somehow magically the stock is trading over 100% year over year. Total and complete insanity for Apple here. Furthermore, in the last report, we saw a significant decline in net sales in the China region. And the question is the Chinese consumer starting to fall out of love with Apple? Are they becoming more patriotic and supporting Chinese brands instead of Apple? Or was the number from last quarter just the fact that the Chinese consumer is waiting for newer products before they start spending? This quarter's report will leave no doubt whether Apple has a problem in China or not. If we see the number picking up once again, that means that the Chinese consumer was just waiting for the new phone to start buying stuff from Apple once again. But if the numbers from China come light in yet another quarter, this will be a massive disaster of epic proportion for Apple. We could see the stock declining significantly. So far, we're looking for the revenue growth year over year. We're looking for net income growth year over year, and the numbers for sales in China. And of course, this is no brainer. We are looking for the iPhone sales numbers. We are anticipating a monstrous number. Apple has all the tailwinds on their side. People are staying at home, they're saving instead of spending, they have a lot of cash. We saw a lot of stimulus, not just in the US, but across the globe. So all the tailwinds are in Apple's side to see a monstrous number for the iPhone business year over year. If that number comes light, oh boy, we're looking for a massive disaster here. I doubt that the number will come disappointing. I'm actually anticipating a very good number for iPhone sales. The problem for this company is the fact that the stock is rallying prior to earnings, and we are already trading at all-time highs, meaning that the expectations are now set higher and higher and higher. Even if we see a very decent number for iPhone sales in the fourth quarter, or what Apple consider as the first quarter, that might not matter at all, because regardless of how good the number is, it is almost impossible to meet the expectations from the stock price right now. So perhaps this is the stock to watch this week. It is Judgment Day for Apple. And lastly, on Wednesday, we have Las Vegas Sands. What are we looking for when we review Las Vegas Sands earnings? We know that the business has changed dramatically year over year, so we're not looking at numbers from a year over year growth perspective. We are looking for numbers from a quarter over quarter growth perspective. Why is that? We want to see if there is an improvement from the consumer side during the pandemic. Are we seeing more reopenings across the globe? And most importantly, are we seeing consumers being more comfortable to visit casinos during last quarter compared to prior quarters? There was a stigma in the beginning about the virus, but as we start to learn how to live with it, there is a sense of normalization. And perhaps casinos, in this case Las Vegas Sands, are seeing an improvement in their business. And here are the numbers from the last report. The Sands China unit, the EBITDA, quarter over quarter was down 25.3%. This was a bomb, a massive disappointment for Las Vegas Sands. So this is the number to watch here. Their Sands China unit is perhaps the biggest, and they need to see an improvement quarter over quarter. We cannot see another quarter of EBITDA decline. That would be disastrous for the company. Meanwhile, we did see an improvement in the Marina Bay Sands. So the Singapore business is improving and recovering the fastest. What about Las Vegas? EBITDA, quarter over quarter, down 67% or so. A massive disaster, and we are looking for the slightest improvement. Any improvement is good at this point. And of course, don't forget that Sheldon Adelson passed away a few weeks ago, so it will be important for the company to announce their succession plans. Moving on to Thursday, starting with McDonald's. Are we going to see the new chicken sandwich optimism rally? That could happen, but I am a believer in numbers and numbers only. And here are the numbers from the last report. The comparable sales in the United States grew 4.6% year over year. However, the weakness came from international markets, down 4.4% year over year. And of course, the weakness came from Europe and China. Meanwhile, the bright spots were Australia and Japan. So once again, we are looking for an improvement in the international number year over year. We cannot see that for this report, McDonald's reporting anything more than 4.4% declines year over year. We need to see the number improving and on its way to recovery. And let's take a look at the chart of McDonald's. We are at a pivotal level of support. You see the trend line going all the way back to 2016. Breaking the trend line will be very negative for McDonald's, and we are looking for the name to capture support from the trend and start trading higher. It will all depend on the pace of recovery in international markets. I am anticipating a positive reaction here from McDonald's shares due to the stimmy money. A lot of that stimmy money went into fast food spending, believe it or not, at least in the United States. But once again, the problem for McDonald's is not from the US market. The US market is actually improving and growing during the pandemic. The problem is coming from international markets. Next, we have Northrop Grumman. And once again, I'm looking to add a defense contractor in my portfolio. So this is a very important week for me. I'm looking for LMT versus NOC. Which company is going to deliver the best numbers? In the last report, Northrop reported 5% growth in their aeronautics systems unit, meanwhile a decline of 4% in the defense system unit, and a 10% growth for the mission system unit. And here it is, the most important unit, the high growth unit of the space systems, up 17% year over year. Once again, all eyes are on the growth of the space systems unit. And while we're at it, let's visit the chart of Northrop Grumman. We are at a pivotal level of support. You see the trend line going all the way back to 2019. And if you want to draw another line, a descending line at the top of the chart, you will see a wedge. And we are about to break one way or the other. My bet is that this is an underappreciated name, and we could catch support from this level and start to trade higher. Once again, I'm looking for the best name to buy between Lockheed Martin and Northrop. Next, we have Visa. And while the stock is trading at all-time highs, magically, of course, the numbers were abysmal from the last report. Net revenues were down 17% year over year, and the net income was down 29% year over year. How the hell is this stock trading at all-time highs? The answer is the overall market mania that we're in these days. For this report, we are looking for an improvement. We're not talking about net income. That is too early. We're looking for an improvement in net revenues, not just year over year, but most importantly, quarter over quarter. That number has to come above $5.1 billion, specifically given the fact that the report will be for the very busy holiday season when consumers are expected to use their Visa cards. Similarly, when we talk about Mastercard, we're looking for the exact same thing. And in the last report, you can see that the net revenue was down 14% year over year, while the net income was down 27% year over year. Somehow, magically, the stock is trading very close to all-time highs. We're looking for an improvement, not just year over year, but quarter over quarter for the revenue number. I am not a fan of both names, Visa and Mastercard. I think that the stocks should not be trading where they are right now. Next, we have Southwest. We will continue our discussion for airlines earnings with the same key metrics that we measured Delta and United based upon: cash burn, short-term maturities, and cash on hand. I am expecting the Southwest's numbers will be better than Delta. If that is not the case, boy, it'll be a disappointment, a big one for Southwest shares. Next, we have Skyworks. And once again, while the name is trading at all-time highs, let's see how they did during the prior quarter. The net revenue numbers have grown about 15% or so year over year. That is an improvement. Likewise, the net income number has grown double digits as well. However, the stock price has grown over 35% year over year. So perhaps the stock is overpricing the story for now. Remember, Skyworks will be impacted by Apple's earnings. If we see the iPhone sales came out disappointing, Skyworks will suffer as a result, because it will be a clear indication that the results from Skyworks will be disappointing as well, and vice versa. Next, we have Mondelez, and I own this name in my portfolio, so I know exactly what to look for. I am looking for an improvement for the gum and candy business. This is the underperforming business during last year. It has been underperforming since the beginning of the pandemic. People tend to chew gum when they go out and about, not while they're staying at home. But that was not a problem for Mondelez, because whatever they lost from the gum and candy business, they have gained in the snack, cookies, and other units as people stay at home and shove their faces with tasty treats. I am also looking for the Latin America numbers. This was the weakest point in terms of the regional performance for Mondelez. They've been outperforming in the United States and Europe during the pandemic. The only lagging segment here geographically is the Latin America segment. Moving on to Friday, we have Caterpillar. And while the stock once again magically trading at all-time highs, Caterpillar numbers in the last report must have been very, very impressive, right? The answer is wrong. Here are the numbers. The revenue and sales were down 23% year over year. The operating profit margin down 5.8 points year over year. The profit per share down 54% year over year. Once again, how the hell is this company trading at all-time highs? The answer is everybody's buying the rumor that the Biden administration will do a lot of infrastructure spending, and we will see a lot of borrowing globally due to the low interest rates. We will see massive global spending in infrastructure projects, and that will be very good for Caterpillar's recovery. These are all assumptions. We don't know that yet. And remember, right after Trump was elected, they said the same thing, that the Trump administration will do a lot of infrastructure spending, etc., etc. We didn't see that at all. So we might not see it with the Biden administration. We're just buying the rumor right now. And let's take a look at the chart of Caterpillar. I see declines here regardless of the numbers. We are very stretched from the 20 weeks moving average. We are starting to curl down in both the RSI and the MACD indicators. I think Caterpillar will trade all the way down to revisit the 20 weeks moving average at around the levels of 175. Next, we have Eli Lilly. And once again, this is a chart trading in la la land since the announcement of the Alzheimer treatment. Now, mind you, they're announcing a potential treatment. They did not announce a proven cure. But the market, of course, is reacting as if we discovered the cure for Alzheimer. So what are we looking for in this report? An update on this new Alzheimer drug. Furthermore, I'm looking at the Trulicity sales number. It has been growing year over year and quarter over quarter. However, in the third quarter, we saw a new phenomena that the Trulicity growth number quarter over quarter started to decline. So the question is, are we going to see a year-over-year decline for Trulicity sales during the fourth quarter? That is very, very possible. So this is what I'm watching for because this is the most important drug for the company right now. And let's take a look at the chart. It is trading in la la land, almost vertical. I expect that regardless of the outcome of earnings, that the chart will go down and close some of the gaps you see since the rally started earlier this year. Next, we have Chevron. And this is a stock I used to own in my portfolio last year. It was the worst performer, so I had to dump it. Are we starting to see a recovery in Chevron? Not yet. The numbers are still abysmal. Here are the numbers from the last report. Bad numbers across the board. Upstream, downstream, midstream. So we're not expecting that Chevron will magically turn the tide during the fourth quarter. What we are concerned about is the safety of the dividend. So we're looking for improvement in their expenses quarter over quarter, and we are looking at the cash flow numbers. The cash flow from operations in the first 9 months of 2020 was $8.3 billion, compared with $21.7 billion in the corresponding 2019 period. So once again, for the fourth quarter, we're looking to close that gap. It's a massive gap, but we are looking to close it in any way possible to make the dividend secure. Next, and the last report we have on Friday is from Honeywell. Here are the numbers from the last report. Sales down 14% year over year. The EPS down 25% year over year. Free cash flow down from $1.3 billion in 2019 for the third quarter down to $800 million in the third quarter of 2020. So a big drop here in cash flow. These are all abysmal numbers. So let's continue with the report. We saw declines in all of their business units year over year, with exception to the safety unit for understandable reasons during the pandemic. So you might assume that the stock must be trading at all-time lows or at least performing poorly. You're wrong. The stock is trading pretty much at all all-time highs. Why is that? Because we are in the la-la land market. We buy the rumor first, ask questions later. And in this report, questions will be asked for Honeywell. How the hell are you going to justify this stock price right now? I see a negative reaction. You see the curling in the MACD creating red impressions in the histogram, a loss of momentum in the RSI, and my bet here is that we will see declines for Honeywell and the stock will close the gap as I'm illustrating in the chart, and that would be a decline of about 8.5% from the levels we're trading at right now. And here we are at the end of this preview video. We have very important earnings, specifically for the big tech sector. It is Judgment Week. This is by far the most important earnings week for this season and perhaps in the market overall for a long time, given the fact where we are in the bubble right now. That's all I got for you for this video. I hope that this was helpful, that you now know what to look for. And if it was, please return the favor by subscribing, pressing the like button, and leaving a comment if you have any further questions. Thank you. I'll talk to you again soon.